Good evening and welcome back to Be Rich. Whether it is the Indian market or whether it is the American markets or any markets, markets have been bleeding for some time and will continue to bleed. And the US markets has already reached a bear market, and the Indian market will soon reach a bear market. Now the question is, how do we deal with a bear market? What should you be doing in a bear market? There are types of people who have invested. One, who are young, who are in their prime and still have a long career ahead of them. Those are the people who have invested in the last 2 years. My advice to them has been to remove your money from actively managed funds and start buying stocks and passive funds slowly at a rate much slower than what they have been doing before. This will ensure that whatever they sold today, they will be able to buy cheaper over the next 3 4 years. It is worth noting that there are two periods in American history which we should be very careful with. When somebody tells you that stocks are always going to do extraordinarily well. In the years between 1960s to 1982, the Dow went from 94.12 to 102. That is in 16 years. That I think in 1966. In 16 years, the Dow moved only 5 points. In this period, the inflation really was raging very high in America till Paul Volcker was bought to crush it. If you have invested like what we did today, what we do today, automatic investment in SIP, what would have been the result is that adjusted for inflation, you would have made $8 or $9,000 for the money you invested. The returns would have been devoured by inflation. So we do not know at this point of time whether just buying on a regular basis will be a great strategy, because we do not know what is going to be the future of the world in the next 3 to 4 years. We do not know how Russia will end. We do not know when COVID will vanish. We do not know when the supply chain bottlenecks will end. As I speak today, Heathrow has said airlines should cut 20% of their flights so that Heathrow Airport can handle luggages. Luggages have been lost terribly in Heathrow because of delays and not transport not being there on time, and luggages not being smoothly moving from one connection to another connection. Therefore, Heathrow has said, please bring down the load of number of aircrafts. People are actually traveling with a vengeance after the COVID has been lifted. This clearly shows that transport and service networks are still facing the supply shortages of labor, material, and resources after the pandemic. They are unable to handle surge in demand. If they build redundancies for surge in demand, what will happen if the surge disappears once this revenge tourism is over? Therefore, it is very difficult to build redundancies. At the same time, there is a huge increase in prices, which is hurting people across the globe. US and Europe are now at 8% inflation. India claims its inflation is 7.08, but at the wholesale inflation is at 15.5, a 14-year high. So something is not adding up. This means that interest rates are going up, but using interest rates to solve this problem is like bringing a hedge hammer to hit a cake instead of using a knife. But the Fed does not have knife or such surgical tools to create delicate and surgery to make delicate surgery so that only the problem areas can be removed. All it can do, use the blunt force of the interest rate hammer. As Fed's interest rates keep going up, it will begin to bite all sectors of the economy, and there is a possibility we may have recession before inflation comes down. This means that we could be in a prolonged period of stock price stagnation where stock prices do not go anywhere and we remain frustrated. The young investor to about whom I talked has the liberty to invest and ride out this market and be bullish. There is another class of investor who is in my age or people who are at their early 60s whose entire nest egg is at risk. Whether they should remove this nest egg or not is $1 million question. At least in the United States, direction is clear. The tips, the Treasury inflation protected bonds has moved from minus 0.22 return to a return of plus 1%. This means if you invest $1 million in tips, not only will it remain $1 million adjusted for inflation, it will also give you a return of $10,000. This really means that inflation is raging in America. So, if stock markets are not going to do well for the next 3 4 years, people who are either nearing retirement or lifetime goals are better served by withdrawing their entire corpus and parking it in safe bonds, which will slightly give them better than inflation or slightly below inflation so that they can tide over this period. The other way that people who are going to retire solve the problem is by taking on part time retirement, that they take part time jobs and make sure that their career is lengthened and they don't have to draw upon their savings to live for the future for some time to come. They can extend this period. If you are in America, you should consider not withdrawing money from your social security until you turn 70. It can make a big difference to your life. So there are two sections types of people, one who are young who can take the hit and another who are nearing retirement will have to take out their money and put it in a savings scheme. Thank you for watching. Be rich. If you like this content, kindly hit the subscribe button and turn on the bell notification. If you do not turn on the bell notification, you will not be notified every time we put out a video. I have written two books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support.